Welcome and thank you for joining us. This video covers the IASB's proposals about changes to the impairment test as part of the IASB's Business Combinations, Disclosures, Goodwill and Impairment project. I'm Vikash and I'm joined by Rika today.
Hello, I'm Rika Suzuki, a member of the IASB. I have an auditor background. The objective of the project is to improve information entities provide about business combinations at a reasonable cost. In 2020, the IASB published a discussion paper on this project. We then analyzed the feedback and re-deliberate to reach a package of proposals. The IASB published an exposure draft with these proposals, which is open for comment until the 15th of July. The two main areas of the exposure draft are the disclosure requirement in IFRS 3 and the impairment test in I-36, which form a package of proposals. This video focuses on the impairment test in I-36. For more background to this project, please watch our introductory animation video. For information about the disclosure requirements in IFRS 3, please refer to our video on the disclosure requirements. In the post-implementation review, PIR of IFRS 3, the IASB had a number of concerns about the subsequent accounting for goodwill. Some stakeholders expressed concerns about the effectiveness of the impairment test in I-36 as it relates to goodwill. Those stakeholders said there appears to be a delay between an impairment event occurring and an impairment loss on goodwill being recognized. This is sometimes referred to as impairment losses being recognized too late. Some preparers said the impairment test is too costly and complex to apply. Some stakeholders said the IASB should reintroduce amortization of goodwill. During the course of this project, the IASB considered all these areas identified in PIR of IFRS 3. The IASB is proposing amendments to I-36 that aim to improve the effectiveness of the impairment test in I-36 at a reasonable cost, and aim to simplify the application of the impairment test without reducing its effectiveness. The IASB considered whether to reintroduce amortization of goodwill. The IASB concluded it didn't have compelling evidence for a change in the accounting for goodwill. As a result, the IASB is no longer considering amortization of goodwill in this project. Vikash, could you explain more about the changes to improve the effectiveness of the impairment test for the cash-generated unit, including goodwill?
Thank you, Rika. The IASB considered why stakeholders provided feedback that impairment losses on goodwill are being recognized too late. We noted the impairment test applies to a group of assets, a cash-generating unit, or a CGU that generate cash flows together. This is because goodwill does not generate cash flows on its own. Accordingly, the impairment test is not a direct test of goodwill. It was not designed to show the success of a business combination or to illustrate a steady decline in the value of goodwill over time. In addition, the IASB noted that financial statements are periodic reports, and therefore there is a natural delay between an impairment event and information being reported about that event in financial statements. The periodic nature of financial reporting means that financial statements can't react to events as fast as investors in financial markets can. We are proposing improvements to disclosures about business combination, which provide more direct information about the performance of a business. Please refer to our other video covering that topic. However, the IASB did identify two potential concerns about the impairment test. Firstly, shielding, which is basically the result of testing goodwill within a cash-generating unit. There might be what is called headroom within a cash-generating unit containing goodwill that absorbs a decline in the value of the cash-generating unit. It is only once the headroom in a CGU has been eliminated that an entity would recognize an impairment loss on goodwill. Headroom can exist for various reasons. For example, the fair value of the assets in the cash generating unit can be higher than their carrying value. Or there could be unrecognized assets, such as intangible assets, in the existing business. Secondly, management over-optimism. Because the recoverable amount of cash-generating units can be calculated using a discounted cash flow method, some stakeholders said that management sometimes use forecasts of cash flows that are too optimistic. The IASB also spent a long time earlier in this project trying to develop a different impairment test. In particular, the IASB looked at the headroom approach. That would build some headroom in the cash-generating unit into the impairment test, therefore reduce shielding. However, stakeholders generally did not support this idea. We instead focused on making changes on the existing impairment test. The IASB is proposing some changes to the impairment test that aim to reduce shielding and management over-optimism. I will now explain these changes. Firstly, I will discuss shielding. When the IASB developed the impairment test for cash-generating units in IAS 36, it knew about shielding and accepted it be part of the impairment test. The requirements are designed to work with an entity's internal management structure to avoid excessive costs. However, the IASB's intention in designing the impairment test was to allocate goodwill at as low a level as possible within the entity to reduce the amount of shielding. Respondents to the discussion paper highlighted some wording in IAS 36 that might result in an entity allocating goodwill to a CGU or group of CGUs at a higher level than originally intended by the IASB. The IASB is proposing some amendments to IAS 36 to respond to this feedback. For example, IAS 36 requires an entity to allocate goodwill based on how goodwill is monitored. However, some stakeholders told the IASB that management within an entity don't typically monitor goodwill, but rather monitor the businesses that generate goodwill. Those stakeholders said that some entities might therefore allocate goodwill at the highest level permitted by IAS 36 as a default. The IASB proposes to change the wording in IAS 36 to refer to monitoring the business associated with goodwill rather than to monitoring goodwill directly. The IASB is also proposing to clarify that the highest level permitted is intended to work as a ceiling rather than a default. The IASB is also proposing some very limited explanations of what monitoring the business associated with goodwill means. These proposals are designed to reduce shielding, but would not eliminate it. Now let's discuss over-optimism. The IASB notes there are a number of safeguards already in IAS 36 against management over-optimism. For example, IAS 36 requires an entity to use reasonable and supportable assumptions. IAS 36 also requires an entity to assess the reasonableness of the cash flows by examining the causes for differences between past cash flow projections and actual cash flows. Given these existing safeguards, the IASB considers that management over-optimism in the impairment test is in part better addressed by auditors and regulators. However, we are proposing that an entity disclose additional information to help investors assess the reasonableness of the assumptions used in the impairment test. IAS 36 already requires an entity to disclose information about key assumptions the cash flow forecast is based on. The IASB proposes to require an entity to disclose the reportable segment a cash-generating unit is included in. This information will give investors more information about where in an entity goodwill is being tested and allow investors to better compare their own assumptions about segments to the assumptions used by management in the impairment test. That's all on improving the effectiveness of the impairment test. Rika, can you explain the changes to reduce cost and complexity?
Yes, thank you, Vikash. The IASB is proposing two changes to how an entity calculates value in use. In the IASB's view, this will reduce the cost of performing the impairment test, but not significantly reduce its effectiveness. The first is to remove a restriction on including cash flows from future restructurings or asset enhancements. The IASB views the current restriction result in less relevant information because it results in an entity using cash flow forecasts that are significantly different from how management monitors the business. And fair value less cost to dispose, the other measure of the recoverable amount of an asset, includes these cash flows. The IASB thinks it is more logical to compare two measures of the same asset rather than one measure including the asset that contains the potential for future restructuring or enhancement, and another measure including the asset that doesn't. The IASB thinks the other restrictions in IAS 36 are sufficient to ensure the robustness of the impairment test. For example, the requirement for the asset in question to be in its current condition. The IASB views the inclusion of the potential for future restructurings to be part of the current condition. Please note, the IASB is not permitting an entity to include cash flows from future restructurings where the potential for those restructurings doesn't exist. The requirement to use reasonable and supportable assumptions. The requirement to base cash flow projections on management-approved budgets, and the requirement to disclose the key assumptions in impairment tests. This allows investors to assess the reasonableness of the assumptions. The second proposal in relation to value in use is to remove the requirement to use a pre-tax discount rate in calculating value in use. Instead, an entity would be required to choose either a pre-tax or post-tax discount rate consistently for the cash flows and the discount rate, and disclose the entity's choice. The IASC, the predecessor to the IASB, thought using a pre-tax discount rate would make the calculation of value in use more relevant. However, stakeholders told the IASB a pre-tax discount rate is difficult to estimate and is not observable. Moving on to the IASB's decision on retaining the impairment-only model. The IASB considered reintroducing amortization of goodwill. We received substantial and conflicting evidence from stakeholders on whether to retain the existing impairment-only model or to reintroduce amortization model. However, feedback shows stakeholders have divided views supported by evidence on the appropriate model to account for goodwill. Many IASB members acknowledged the pros and cons of both models. However, based on the evidence, we concluded it doesn't have a compelling case to change from the impairment-only model, either to improve information provided to investors or to reduce costs for companies.
Thank you, Rika. That concludes this video. Remember to watch our introductory video and our video on improving disclosures about business combinations. We look forward to hearing your comments.